Untold Stories is a conference started in 2019 by Startup Europe Networks and Startup Hungary. We believe founder stories are powerful, and we pride ourselves on having real, no BS conversations to inspire and educate our community. Building off of our offline events, we developed this podcast with TechCamp Global to bring you untold stories from the region's best founders year-round. In each episode, we try to uncover the details and hands-on tactics behind the founders' successes so you can skip their mistakes and benefit from their years of experience and lessons learned. Our hope is that you will be able to find new ways to accelerate your growth. Let's dive in. My name is Mary Alcantara, and this is the Untold Stories podcast. Jared Schrieber is a serial entrepreneur and angel investor. Born and raised in the U.S., Jared relocated to Hungary full-time 3 years ago and is on his way to becoming Hungary's first superangel. Earlier this summer, he exited from Numerator, a market intelligence company that helps brands and retailers understand consumer behavior, which he grew to a unicorn. So we're excited to hear all about his journey there. We have a ton of topics to cover with Jared. This is a little bit of a different episode for us. He'll be sharing his experience as a startup founder and more recently angel investor, but we'll also be hearing his take on the Hungarian ecosystem. So let's dive right in. Great. Jared, thanks so much for being here with us.
Thanks for having me. Appreciate it.
So one of the first questions that we ask all our founders is just what got you into this whole entrepreneurial game? So tell us about your journey.
Oh, boy. I feel like it started with lemonade stands when I was a kid in the U.S. But
so it goes way back for you.
It goes way back. It's been a bug in my system since I was little. Grew up going to the flea markets, buying and selling little things. So I think I've always had a little bit of it in me. And I knew after my first career job at a big company, Intel Corporation, back in the late '90s, that I didn't want to work for a big company. I wanted to create something myself.
And so I guess Numerator wasn't your first rodeo. Maybe you can tell us about some of your other companies that you were part of along the way.
Sure. I think the core of my entrepreneurial journey started when I finished grad school. I really looked for a startup to join. And unfortunately, I didn't find the right one, and I didn't have the right idea that I felt like pursuing myself. But I knew I had some gaps in my own skill set and experience. And so I joined Teradata at the time, which had the world's largest data warehouses, and got an opportunity to learn sales, business development, marketing, go-to-market, all of these areas that I didn't have experience in from my Intel days. And from that, I came across a startup that was early in the RFID analytics space. This is back in early 2000s when RFID was going to take over the world and every product was going to have an RFID tag instead of a barcode on it. And so a startup that had successful founders who were serial entrepreneurs, had some early funding and early traction, and I joined them as their first outside executive. And that really got me into the entrepreneurial game and moved me out to Silicon Valley, which of course is a mecca of the startup ecosystem.
What was your role there? What was your responsibility?
Yeah, I started off leading services. So we would get data from Walmart, Target, the largest retailers in America, and the brands that service them. And I led the team that did all of the analytics on that data. And then very quickly was promoted to lead products and services, so in charge of product management as well, building the analytics products, and then over time also ran business development for the company.
So let's talk a little bit about Numerator. Was this the first company that you started?
Actually, I started one nights and weekends while I was at the prior startup, and I was trying to create a marketplace where a consumer could get any product personalized in any way that they wanted. And just realized I wasn't the right person to do that. It wasn't a fit for my skill set. So I actually shut it down before leaving my job full time. But when I had the idea for what became Numerator, that was a really tight fit with what I had been doing with the prior company, and felt comfortable to go full time at it and build it.
So Numerator was originally called InfoScout.
That's right.
And so, yeah, just tell us, what was the origin story there?
The origin. So the prior startup that I helped build was called Retail Solutions. And we ended up convincing retailers to share the point of sale data with the brands who sold products through them. And we built a whole bunch of analytics that the brands and retailers could use together to optimize the assortment of products they carried, the promotions they ran, the pricing of products, et cetera. And one of the things I realized working with the brands is they had a lot of questions about what was happening at retail that they couldn't get answered off of just store item day level point of sale data. They needed a consumer level understanding of what consumers were doing every time they shopped, no matter where they shopped. And this was a gap in the marketplace. And at this time, back in 2011, smartphones were starting to pick up in terms of adoption. Actually, the US was a late adopter. Only a third of households had smartphones back in 2011. But I made a bet that every household is going to have one. And when they do, we can create apps that incentivize consumers to take pictures of their everyday shopping receipts. So no matter where they shopped or what they bought, we would incentivize them to take a picture of their shopping receipt. They would get a reward that they could cash out later, and we would get the data. And we could anonymize that data and use it for market intelligence for brands and retailers.
So kind of like for cross-selling, or okay, these kind of customers buy these kind of goods together, or all kinds of different use cases.
A basic use case is you see promotions in stores all the time. It's actually the brands who fund those discounted prices and promotions. And what they want to know is, are they reaching new consumers who weren't already buying the product, or did they just subsidize the purchases of existing consumers who already buy the product at regular price, and now they just loaded up their pantry at a discount? And you can't do that. You can't figure that out with point of sale data. You need to understand consumer level what individual consumers are doing, and we could answer that kind of question. And there are 100 more as well.
And this is what you did with InfoScout.
That's exactly right.
And so you started that company back in 2011.
That's right.
Okay. And so you started it, you quit your previous startup and you went all in.
That's right.
How many people did you have with you in the beginning?
Well, in the beginning, it was just my co-founder, amazing guy named John Braylig, also a serial entrepreneur. He had worked for me briefly at the prior company, Retail Solutions. So our paths had crossed. We'd worked together. And he had an exit from a startup that he had founded in between, and we joined forces and built InfoScout. It was the two of us. We put in a little bit of savings and got to work and started the fundraising path. And we thought, given our track records, we'd have no problem with a PowerPoint as a pitch deck, and we'd be able to go raise some angel money and get going. And turned out to be far from the truth in terms of what actually transpired. We struggled to raise money in the early days, and we started burning through our own investments and savings. We're going without salaries, of course, and started getting a little desperate there about 5 months in of, are we going to be able to pull this off, and how are we actually going to get some funding?
So how did you get past this phase?
Well, two things. One is, instead of trying to solve all the different problems we thought our approach and technology could solve for the market, we focused on one. And we built our first app and got it to market. And I really credit my co-founder, John, for making that happen. That was his idea, his focus, and drive to make that happen. On the angel fundraising side, I got some advice from a serial entrepreneur who basically said, Jared, what you need to do is get your first angel, your lead angel, the one that others will follow. Well, what does that person look like? Well, they probably have some experience in your industry or domain, so they have some credibility. And I go, well, how do I get them? Well, he says, look, you offer them the opportunity to be the lead. And if they lead, in addition to taking their investment and them helping set the terms of the deal, you give them an advisor agreement on the side that boosts the equity a little bit. I followed this advice, worked like a charm. We got our first lead angel with them as a credible lead. So many others followed, and immediately we were off to the races.
And how big was that first angel round?
The first angel round was $450,000.
And that covered you, that gave you runway for?
That gave us runway for about a year, and we ended up getting term sheets for our Series A by before the end of 2012.
Wow, okay. And how important was it for you to have that, I guess, traction in the early days? So you said you really had...
That's a great question,
You were not getting a lot of attention, because I think we have this perception here that, you know, in America, people just throw money at ideas and everything, but maybe that's more the case now. But
maybe
10 years ago, it
right.
might have been a bit trickier.
It was a little different. Traction is a word that was probably my least favorite word in the English dictionary back then. Because what would happen is I'd pitch angels or pitch VCs, and the best feedback I would get was, you know, we'd just like to see a little bit more traction. What is traction? We're a B2B2C company. Does that mean we have more consumers using our product or platform? To what level or extent? Does it mean we have more clients paying us for the data? To what level or extent? What is traction? Like, what does that mean? And so, you know, fortunately, we figured out it meant we need to be collecting as much data as the biggest rival, the incumbent in the market, with a nice growth trajectory behind it that shows we're going to really outperform them. So that turned out to be the traction that we needed. We focused on that. Once we had it, VCs were lined up. We had plenty of term sheets.
Yeah. I think I think traction has become this sort of catch-all, because for a lot of startups that are pre-revenue, you talk about traction. Okay, well, how many customers, how many eyeballs do you have on your product? What have you done to kind of validate the solution? So that's interesting that you say for you, data became kind of what was convincing in terms of, growth and being able to grow that. But how were your early sales in those days?
Almost non-existent, really. What we were doing, we had a B2C business. And so you have a chicken and egg problem. Do you grow the consumer side or the business side?
Because you need the consumer data to make it compelling for somebody to pay for it.
Spot on.
Yeah.
Spot on. So that actually dictates which comes first. Exactly what you said. We need the consumer data to get the brands to pay for it. So that means we have to solve the consumer side of the equation first. And the key in B2B2C and often marketplace type businesses is you have to figure out how to unlock the chicken and the egg. And the key is actually, how can money unlock one of those sides of the equation for you? And in our case, the angel investment allowed us to do user acquisition and user incentives that got more consumers taking pictures of their receipts, providing us the data. Once we started getting meaningful data, not only did VCs have interest because they believed we could monetize it, but brands had interest then in actually buying our services.
So you spent that whole first year basically and your whole angel round on getting customers to interact, consumers to interact with your app and actually upload their receipts and get that data.
That's exactly it.
And then you got your Series A.
That's right.
And you were off to the races, as you said, and you were able to start selling.
That's exactly right. So from there, we started building the B2b product. And we weren't exactly sure what to build at first, actually. So what should it be? Should it be a data product? Should it be a business intelligence platform with a Tableau interface? I mean, what should the product be? And so that was a challenge for us in terms of figuring out, and who exactly should the customer be? Okay, brands, but brands have thousands of employees. What role specifically should we be focused on that is really underserved, that we're best positioned to address their needs?
And what did you come up with?
So what we came up with is not to go after where the incumbent was generating all of their revenue, even though that revenue looked attractive for us to go steal. It turned out there was a role called Shopper Insights that brands had focused on individual retailers at Walmart, at Target, at Walgreens, at Kroger, at all these big US retailers who were focused on how do they improve their sales through that retailer. And it turned out that the incumbents like Nielsen and Kantar didn't have enough data to answer any questions at the retailer level. They could only do it at the total national level. And so this group of people was completely underserved by the incumbent. And so we focused completely on their needs. And by doing so, we didn't have to beat out the incumbent. We could generate new monies and new revenues that didn't exist anywhere before.
And how did you, I guess, target those Shopper Insights people? Did you have kind of my assumption would be you had a previous customer base maybe from your time at Retail Solutions?
It helped a lot that I came out of the general space, which was selling insights to brands. Unfortunately, it was a completely different function and budget holder, but because I'd done nice work for those people previously, they were willing to introduce me to their counterparts. That helped get the ball rolling.
Interesting. And I guess you had this narrative already when VCs were approaching you for your Series A.
That's exactly right. That's exactly right.
So you've seen, I'm sure we could go through every year of this whole journey, but we want to talk about other things today too. But I want to just kind of go through, because you've seen it all. So you've had, starting from the angel round, Series A, B, C, and that, being acquired. So I want to, I think you've made it past a lot of milestones. So we want to just hear about.
Talk about some of those milestones along the way. Yeah. I think it's interesting. Obviously, the angel funding allowed us to get our apps into the market, get the consumer side of the equation solved. We raised a traditional Series A led by Bain Capital Ventures. And that allowed us to start building our B2B product and start bringing it to market.
How big was that round?
That was let's see here, $3.5 million.
Okay, so pretty
normal
modest.
For the time. Yeah. Now that's a seed round. It's pretty
well,
funny.
Exactly.
The whole definition has changed of what a round is.
It's interesting.
So think of it as a seed round for those of you listening nowadays. But back then, that was actually a normal Series A. So we raised that. That allowed us to build the product, get some early traction. At that point, we had interest in a Series B round. And we ended up having a strategic investor, so a potential competitor in the market on a global scale, take a real interest in us. They had wanted to do a joint venture, which we turned down, but we gave them the opportunity to lead our Series B. And turned out great, actually. And so we took strategic investment, which comes with a whole lot of hair that needs navigated carefully. But it worked out well for us. And then as we continued to grow, we had an option of a Series C.
Well, wait a sec. So how big was the B round? It was
17, 18 million.
Okay. And this was a potential competitor. So
yes, not in the U.S., but as we started looking at expanding internationally, they would be a competitor. So it was really a tough challenge for us. And so, they would make us offers, we'd say no. They'd raise their offers, we'd say no. They'd raise the offers, we'd say no. And then finally, it got to the point where we can't say no to this.
Wow. Yeah. I mean, and how I'm sure there's a lot of second guessing you probably do at some point
Always.
in that journey. But how was it and they wanted to do a JV, which you turned down. So I guess what finally convinced you, the terms or the...
Well, at some point the terms, but also just you continuously have to look ahead and say, what are we trying to build? How are we going to get there? How does this affect us strategically in terms of what we want to do over the next 5 to 10 years? And at some point, you can look at those things and say, we can get this to align. This will buy us so much runway. This will create credibility for us in the market. This will accomplish these things. And if we can manage these risks of the deal, which our venture partner at Bain Capital Ventures helped us figure out how to manage in the terms, then we could get over the hump and move forward.
And ultimately, they were able to, because they now had equity in they were kind of aligned on that side. So they kind of helped you in the story instead of being a competitor later on.
That's right. That's right.
Can you tell us maybe an example of, I don't know, something? Did they bring you to their customers? Or
absolutely. So there were a few customers that we had in common, but we were doing different types of work for them. We could go in with a joint pitch and story. They were credible around the world in terms of their approaches and methodologies of the insights that they were bringing clients, and we could piggyback off of that at times in terms of our conversations with clients that we had benefit from this incumbent provider on a global basis. And so there were just a number of areas. I wouldn't say the synergies are what made the deal make sense at the end of the day, but it also created a strategic threat to the other incumbents that when it came time for a potential exit later, actually increased the value of the company versus decreasing the value of the company. A lot of people get concerned, if you take strategic investment from one company, are you setting yourself up where your only exit potential is that strategic investor? And there's actually a lot of ways to avoid it, and it can actually increase the competitiveness of a final exit.
That's really interesting. Yeah, because you would expect that your strategic investor would maybe have first right of refusal or something to be able to buy.
And there are clever ways of managing that.
I see. Yeah. Okay. So you had sort of maybe complementary services, although you were doing something maybe a bit more innovative and something that a lot of the other competitors were interested in.
Right.
So by establishing your presence and being kind of the leader there, then you're in a great position on the market.
Exactly it. That's exactly.
Okay, so this is the B round. So then, but with the Series C round, then it was yet a different type of investment,
Series
right?
C, we were growing like crazy, but we were burning cash like crazy to do it. I mean, it was just a situation where to keep the growth going, we needed to burn cash. And to burn cash, what that meant is we needed to continue to acquire and incentivize more consumers, and we needed to hire more and more salespeople. When you hire salespeople, there's a certain payback period associated with that. They're not selling anything really in the first 6 months.
Right.
And then by the time they start really selling after 9 months, if you're on a subscription service, it's not like you get all the cash up front from your client. It starts trickling in over time. The long-term value is there, but in the short term, you're burning cash as you're trying to grow. And so we wanted to keep our foot on the gas pedal. We needed more capital in order to do that. For us, Series C terms from venture capitalists weren't looking great. We weren't excited about it. And so we looked at an alternative, which is venture debt. So instead of selling equity, we took on debt that has, let's call it, higher interest rates and some warrants and other things. And it was controversial among our executive team, among our existing investors. But at the end of the day, we did the math, and just in almost every scenario of how things could play out, it looked like it would be better for us. And so we took on $8-9 million of venture debt from Trinity Capital, and which just IPO'd this year, by the way, as a company themselves. And it turned out to be one of the best moves we could have possibly made. because it was non-dilutive in the end.
Right.
Yeah.
Yeah, I think that's the flip side. So can you share kind of the terms of that deal?
I mean, these terms roughly, they come with 1% to 2% of various fees to get them going at the started. You've got interest rates of 11 to 15%. There's some payoff fees at the end, and then they get some warrants on stock in the company that can add up to, let's call it 1% as well. And so it's not cheap.
Yeah.
But if you actually do the math, if you say, if we keep growing with this cash,
your equity will only increase. And if you keep that.
And what it means to yourself and your existing shareholders means they're keeping a much bigger chunk of the upside as a result. And that's what happened.
But you have to have rock solid confidence in what you're doing.
You better believe that you're going to keep growing at that point.
Yeah.
That's right.
And that's really interesting, what you were talking about with the sales cycle being long, basically, because it's a B2B solution. That's so you're saying kind of 6 to 9 months to onboard a new customer, and, the subscription fees, start trickling in.
That's right.
So I guess you probably knew at that point that your churn was low enough that you could be confident.
Yeah,
in
we
the
had
process.
Negative churn. So our net revenue retention was 130% year over year.
Wow.
So if we could land a client, we could expand them and scale them. And we also knew we had a sales motion that worked, that if we hired a sales executive, gave them 12 brands to call on, we knew when we would close the first one and the next one and the next one, and we knew what kind of value that they would bring in. And so we had a repeatable go-to-market and sales process that we knew we could scale.
What year was this?
Oh, I would say that was really happening by around 2015, 16. That started to really scale. I think the Series B was 2014, just as we were starting to get our first real enterprise sales contracts in, and before we'd really even delivered on them. But then by the time we're talking about the venture debt, we were 2016 at that point.
Yeah, it's super interesting because I think, having that understanding of your customer base and your metrics, so knowing that the acquisition
That's exactly right.
Costs would not be more than your lifetime value, and having that confidence to invest there.
And having high net revenue and gross revenue retention was key.
So you already had these kind of numbers to back up your strategy, and VCs still weren't. It was still too risky for them.
A lot of VCs didn't like our business for about 3 different reasons. One was we found a way to what we thought was shorten the sales cycle by doing initial project work for clients that wasn't subscription. And VCs often have an aversion to that.
They're scared of that.
They're scared of that. And the only VCs who had an interest were the ones that we could convince that actually by selling a project, we're getting a customer to pay us to sell into them further on a profitable basis.
It's a paid audition. Yeah.
Exactly.
Yeah.
We can prove our ROI to them and get paid for it. It's actually a great business model. And it truly is, but a lot of VCs just have a visceral reaction to any kind of project-based revenue.
It's not scalable.
The other one is in some ways we had the economics of a DaaS business instead of a SaaS business. So data as a service as opposed to software as a service. Data as a service businesses, to build a data set at scale that customers are willing to pay for, you're spending a lot of money early on as you try to start monetizing it and selling that same data 100 times over. But if you're only selling it 20 times over, your gross margins don't look very good. If you sell it 100 times over, your gross margins look better than a SaaS company.
Right.
We weren't there yet. We were showing the growth and the traction, but if our cost of goods sold are 45% instead of 30%, it means we've got 55% gross margins instead of 70%, which is the target for a SaaS company. So we just didn't fit the model of a SaaS company, and there weren't many DaaS examples out there at the time. I think that's starting to change, where VCs are waking up to the economics of DaaS and how they're different and why they're actually more attractive. But we were fighting that battle at the time.
So that was the second reason. And you said there was 3 reasons that VCs didn't like you guys.
Oh, boy. Let's see here. So...
doing projects to get in.
Doing projects.
That's scary.
The gross margin economics.
Okay, so after the Series C venture debt round, what happened next?
Yeah, so we continued to grow the business, and we ended up finding a really interesting opportunity to merge the company with a large company in the space that we didn't directly compete with, but had complementary data sets. And they had kind of stalled on their growth, but were generating a lot of cash flow. And that cash flow was exactly what we needed to continue to fuel our growth. And the combination of the two companies, sure, it could create product and go-to-market synergies, but immediately day one would create financial synergies because all of a sudden the revenue was that much higher, the cash position was that much stronger, and there was cash flow to fuel the continued growth. And so with the help of Vista Equity Partners, the largest private equity in the software space, we worked together to merge InfoScout with what was at the time called MarketTrack, and we rebranded the joint company as Numerator.
And this was in
2017.
Okay. Mm-hmm. And how did that look how did that impact kind of day-to-day operations? Were you guys able to kind of stay independent, or did you really, you had a rebrand, so now it's a whole kind of new company?
It wasn't easy, just very simply. We had this startup vibe and culture. We were doubling, tripling every year.
How many people did you have at that point?
At that point, we had about 130 team members. Mm-hmm.
And MarketTrack?
They had about 500.
Okay. Mm-hmm. So you're coming into this kind of
more
corporate.
They think they're kind of bigger and larger because they have more people, but in fact, as a business, the InfoScout business was clearly going to be the growth engine and the dominant revenue provider for the company.
And what was your role in Numerator?
So I was CEO of InfoScout Continuing. I was invited to be CEO of the entire entity and chose instead to take a board position and help with a transition to another CEO over the next year.
Why did you make that decision? Did you see the writing on the wall, or you knew you wanted to exit and do other things eventually?
I think it's actually the same story. Why am I in Hungary now? And the simple answer is, I'm a love-refugee, as they say here. Yep. My wife is Hungarian. We've been together for 21 years, almost all of it in the U.S. We have 3 awesome teen kids who I just really haven't been able to spend enough time with building startups over the last 15, 20 years. And so this was an opportunity to take a step back. It just presented the perfect opportunity. The company had gotten to a certain size and scale where actually, whether it was me running it or somebody else, maybe it wasn't going to make as much of a difference. I'm a little bit more of a early stage startup guy. I think my strengths play to between 0 to 100 employees, not between 100 and 1,000, or now there's 3,000 employees. I mean, it's just a completely different scale. It requires different skill sets. I think it worked well for me on the board and being very involved in product and go-to-market and other aspects of the company up until this summer. But I actually don't think I was the right person to be CEO of such a large-scale company as it kept growing.
Interesting. So how was it basically you hired your replacement and onboarded that person, right?
To some extent, yeah. So look, Vista Equity Partners are experts in this space, and so they really brought the skills to the table in terms of recruiting and hiring and onboarding, and I became a partner to that CEO to help them continue to grow the company.
Cool. And so you were still involved, though, until this summer. So
That's exactly right.
So what happened in the last 4 years?
Well, quite frankly, the company just continued to grow and grow and grow. I mean, as I said, we're up over 3,000 employees now, and the company's just been a complete rocket ship. It's been a fantastic ride, I think, for everybody involved. And what happened this summer is that a very large strategic acquirer, actually multiple of them, came and decided it was time to take the company off the market as its own independent entity before it became too big. And as a result, we decided to go ahead and take the exit.
Wow. Okay. So you went through this big merger and then you were acquired now. So, and there wasn't any sort of, so you were a board, you had a board seat basically. That's right. this whole time. And now, are some people, is everybody staying, or was there any?
A huge chunk of the people are staying. So what actually this large acquirer, who's an incumbent, who's been around for many, many decades, decided, let's not take this company over completely and try and have it operate the way that we operate. It's too innovative. It's growing too fast. Let's let it continue under the Numerator brand with the Numerator leadership team, who are excellent in place, and let them keep growing this business for years to come. So it's actually almost a wholly owned subsidiary that operates 99% independently of the large acquirer.
Was there an opportunity for you to stay involved? And how hard was it to walk away, I guess?
Well, let's say that question is still up in the air.
I
So
see.
it's not fully resolved
Okay.
of whether I'll be, kind of continuing in some capacity or not. But I love the company, I love the people, and we'll see. At the same time, I'm pretty excited about what's next for my own kind of career and endeavors.
Yeah, great. Okay, we'll talk about that in a second. But the CEO who came in after the merge, he's been there the whole time.
He's been there since, oh boy, I think 2018, 19 now.
Okay.
And he's just done a fantastic job.
Yeah, cool.
Yeah.
And the board stays intact or no?
Nope.
Okay,
New board under the new owners.
Okay.
Exactly.
I see.
Yep. So that's what had me deciding, okay,
Yeah.
time to move on.
Yeah. Well, congratulations. I mean, it's an amazing story. And I think, just having gone through all these different types of funding rounds, just gives you that different kind of perspective and, being able to evaluate all these options. I think, it's great to talk when it's, not always this traditional kind of, VC path.
That's exactly right.
Because I think, we tend to kind of glorify that, but if it doesn't,
it's not the best option.
What makes the most financial sense,
Exactly.
And yeah, really just, I think what really stands out to me is just having that confidence to keep pouring cash into the business to get to that growth. I mean,
that's tough.
There's a lot of examples in the past, 5 years before I think we really understood, or before there was this kind of, startup terminology for these sort of things like cost of acquisition, lifetime value. I think when you were going through this, probably nobody talked about it in those ways.
It was early. I mean, we were all learning, and fortunately, there were a few great thought leaders out in Silicon Valley who were publishing information and benchmarks and statistics and ways to think about the problem. And boy, I was soaking them up like a sponge as best as I could and figuring out what applied and what didn't that we could leverage.
Yeah, there's just so many kind of cautionary tales, I guess. Like, what was that one, Homejoy, or
sure, a lot, yeah,
where they basically did the same thing, but it failed because they weren't watching their churn, and they poured a ton of money, they got a ton of users, and then ran the business into the ground.
And gross revenue retention are critical in that case. Absolutely. You have to get those right.
Cool. Well, that's a really amazing story, and congratulations on all the success. So Numerator, the final. Is it public, the final valuation? Or
people can Google and get a sense. It's not official, but
unicorn status, though. That's what we're allowed to say on air here.
Sure.
So now this takes you. So after the merger, that's kind of when you started spending more time here, I guess, and you moved here and full time, and got excited about Hungary, being a love refugee, but also just can't stay out of the startup world.
I can't.
When did you start your angel investing activity?
Well, I actually started my angel investing while I was still CEO of InfoScout and the Numerator. I was fortunate enough to have an opportunity in one of the funding rounds to take some money off the table and start actually investing it. So I've been angel investing since 2014, but not as a primary activity, as a secondary. And so now that I find myself with a lot more time and energy on my hands, I'm starting to really ramp that up. So I have a portfolio of about 25 angel investments. It's growing about 2 per month, I would say right now, and am a limited partner in a few VC funds as well.
Tell us about your first angel investment. Did you know you wanted to do this, or did somebody come? Okay,
I knew I wanted to angel invest, and I just found the right opportunity. It was actually a consumer goods company, a very healthy flavored water as an alternative to the high calorie, high sugar, high crazy ingredient list beverages in the market. A really passionate founder mom who wanted a better drink for her kids. It was starting to get early traction, and I just really believed in the product. I love the product myself, and she's an amazing founder CEO, and it's called Hint Water, and it's doing phenomenally well. Actually, it's been quite a growth story.
And how much did you invest in that company?
That was $50,000. Mm-hmm.
That was your first foray.
That was it.
And it's still alive, still doing well?
It's doing well. It's doing very well. That's going to be a very nice outcome.
And from there, it was just okay, this is going well.
This is
Let me
fun.
roll up my
This is fun.
sleeves, dive in.
No, I think it's look, sometimes you just come across early stage startups, especially if you're a part of the ecosystem and networking like I was.
And putting it out there that you're open to invest.
Well,
so
here's the funny thing. In Silicon Valley, you don't actually need to do that.
people will approach you.
If you're a successful founder CEO, people are going to approach you.
They just assume that
They
that's
just assume.
the next
They
part
just
of
assume.
the evolution
That's
for
exactly
you
right.
in your
That's
career.
exactly it.
Did you have any, have any of the companies that you've invested in gone under? I mean, do you have any failed stories?
I have no complete shutdown failures at this point. I have
Wow.
one that just really couldn't find product market fit, and they took an acqui-hire, and it didn't fully return the money to the investors. But quite frankly, that's totally fine. There was nothing wrong with what they did. It's the way that they were early movers in the voice analytics space as you started having Alexa and Cassandra and Google Assistants coming on the market and in-home devices for these voice assistants. It was a question of how is this ecosystem going to evolve? And I think they did everything right, but the ecosystem didn't evolve in a way that allowed third parties to really get in and monetize in a way that other platforms have emerged.
Yeah, it's interesting. Because I think there's a few people here who have been kind of dabbling or trying to get into angel investing, and I think your first few experiences really have a big impact on whether you want to keep doing it.
That's
right?
Probably true.
And
That's
I know
true.
just from speaking to some, you just learn. You learn a ton, first of all, just from doing. I mean, obviously, you had been through this before, and
Sure.
kind of being in Silicon Valley, and there's a bit, more of a culture for this,
Absolutely.
which we'll talk about in a
Sure.
second. But just, how. What if, I guess it's hard to look back, but how important do you think it is to have a good experience the first time for prospective angels coming into this?
I don't know. I think the lead time to see whether or not you've made a good investment or not can be really long. And actually, the better the investment, the longer it's going to take
to actually get a return.
Exactly.
Yeah.
Exactly. It's the failures that are done in 1, 2, 3 years. It's the successes that take 10 years before you can really tell if this is going to work out.
And by that time, you've kept going, and
That's
so
exactly
you're kind
right.
of
That's
you
exactly
have a
right.
portfolio.
That's
so.
exactly right. And I think fortunately in my situation, I started doing it while I was still CEO, getting a better understanding for how it works. I had some great mentors who were founder angels as well that I could learn from, and I think it's just put me in a great position for where I am today.
Have you had any exits? So you talked about this acqui-hire where it was kind of an exit, but maybe not a full return. But
there's been one other, but quite frankly, out of the portfolio, it's active and running. So. And
how I guess every company is probably different, but how active are you on a monthly basis with your companies?
Yeah. Oh, in terms of engaging with them? Yeah. So there are about 6, 7 where I'm a formal advisor to the company in addition to being an investor. And what does that mean? That means I'm probably on a monthly call with the CEO and covering any topics that they feel like they could use a sounding board for, and that often they're sending me pitch decks or funding terms or other things to review and get my feedback on in between. For the ones where I'm not a formal advisor, I just get calls and emails out of the blue asking for quick takes and advice on things, and it happens quite regularly. And then when something strategic or big comes up for the company, I jump in with the CEO and try and help them figure it out.
And these 6 or 7 where you're a formal advisor, is this kind of the similar structure to what?
That's exactly what it is
and
to what I did with my first lead angel.
And do you bring that as an option, or do they approach you, or this is kind of understood?
It has to be a mutual fit.
Yeah.
I never want to force that on a startup. You can have me as a lead angel and I'll set the terms, but
I also want an advisory deal.
Yeah.
Yeah.
No, that's not fair. If it's great for the startup and that's what they really want, and it's a mutual fit in terms of working together, and I think I can add that kind of value, then I'm open to it.
And you mentioned you're LP for a couple of VCs.
That's right.
As well. Which can you share?
So Bain Capital Ventures, who I had a great experience with.
Okay.
Their Innovators Fund, and then Commerce Ventures, which is very focused on fintech, retail space, and everything kind of in between. I love their vertical industry focus. Great lead partners there, and so in both of these, not only am I an LP, but I'll often co-invest with them as well. And then moving to Europe, I wanted to get involved in some European funds. And so my first one on that front is Flashpoint. They're a SaaS-focused firm with a Hungarian founder of the fund. And not only do they do earlier stage, let's call it Series A type investments in SaaS companies, but they've also moved upstream to a little bit mid to later stage. They're also doing venture debt now. They're doing secondary. And so because I've had great experiences with all of those, I'm an LP in each of those funds.
Wow, awesome. Yeah. Cool. And for your angel activities, is there kind of a specialty focus? Or what would you say is your kind of thesis as an angel?
Well, a couple things. Let's talk about Hungary in particular, because I really wanted to get to understand the Hungarian ecosystem before I started coming in and just making a bunch of investments. I think that would have been a mistake. And what I've learned over the last couple of years, meeting with founders, meeting with the existing angels, meeting with VCs and others, is there seems to be a real gap at the first check level for founders here. If you think about founders in Silicon Valley, we had already worked for tech companies that were like Googles and Facebooks and Intels and had, the types of opportunities to grow our careers and put some money away so that when we went to launch something, we had money in the bank. Or we worked for a startup that had success. We got an exit. We had some money that we could use to fund founding our own company. That doesn't exist in Hungary for founders here. They don't have that, and they probably don't have the kind of savings to put tens of thousands of dollars into starting that business, and they may not be able to afford to go full-time day one, because what will they do for a salary? And then on top of that, their friends and family probably don't have tens or hundreds of thousands of dollars to give them towards their startup right out of the gate. And then compound that further with, where are the angels here? There are some great angels here. I mean, they're great. They tend to focus a little bit later stage, want to see a lot more traction, and they tend to do a few deals a year. And so what that means is there's kind of a void in the market in terms of who's writing those first checks for founders who are trying to get to a proof of concept, a prototype, a first customer, something where they can have a semblance of product or traction that can be used to raise the next capital.
And for you, first check, what does that mean in terms of size?
Yeah, I mean it can be as little as 10,000. It's probably more commonly closer to 50,000. For first check, and often startups need to raise more than that. So I have a network of angels who are willing to take those earlier stage risks, pre-seed level, and help get companies launched.
And because that's what your lead angel put in. Was
That's
it
right.
50 or
they put in 150?
They put in 150,
yeah.
But that whole round was 450.
Yep.
But there were people with smaller checks, right?
We took checks of 5,000 if we thought they could add value.
Yeah.
Right.
Yeah, which I think is also I'm glad you brought this. Is what I want to spend the rest of our time talking about, with kind of comparing and contrasting kind of the angel ecosystem in Silicon Valley versus here. But I think there's this perception that even angels in Silicon Valley will put in tons of money, but I think that's just totally not true, right? You can start with as little as 5,000, and it can be not traditional angels. The 3F round, right? I mean, it's find somebody who's in that space, or your long lost cousin, or anybody you can convince to believe in you. I guess in the beginning, because I'm curious your take on this too, but I think there would be there is capacity. I think there are people that have at least 5,000 in savings here, who could be activated, but we don't know how to do that in some ways. It's, maybe.
Well, there's some real barriers here, actually.
So let's talk about those.
So even if you're an angel interested in being an angel investor, which you probably don't have much experience in here, but let's say you were interested and you had the money to do it, what are the vehicles by which you can make that angel investment? So here I am. I'm familiar with the different vehicles. I'm ready to go. And I learned that I can't do convertible notes as a way to invest in startups here. If I were making 1, 2, maybe 3 convertible note investments in startups a year, that would be fine. I'm looking to do these every single month. That's illegal in Hungary. It's illegal because it qualifies as a banking activity. I would have to be a registered bank. No angel's going to register themselves as a bank or a financial institution in order to make early stage startup investments. That doesn't make any sense. So all of a sudden, convertible notes, the primary mechanism by which the earliest stage startups get funded around the world, not just the US or Silicon Valley, is off the table in Hungary in 90% of the cases. So then you go to a backup, which is the safe note, which is emerged over the last few years. Y Combinator created
Right.
it. It's not officially debt. It's a warrant on future equity. So it's a secure agreement for future equity. That's what a safe means. There's no interest rate. There's no maturity date. So therefore, it's not a loan. Even on the balance sheet for the company, they don't have to record it as a loan. It's recorded as equity. It's not clear whether or not that's legal in Hungary or not. So I'm looking for a formal opinion from in Hungary as to whether or not I can use safe notes as a vehicle. So here, the two primary vehicles are not available. I'm not saying they don't happen or exist, but it's just not a generally available and accepted term. And I've talked to some founders here who are like, I don't know about this safe thing. I'm not sure I want to do that. In the U.S., a founder would be, let's go, let's move.
Yeah. So how are you? Have you done any investments in Hungary so far?
I finally closed my first one in Hungary. It's funny. I've founded more Hungarian startups outside of Hungary than I have in Hungary.
So you're helping them set up,
or
Delaware,
they have.
Okay.
So, Delaware C Corp. We've got one in Silicon Valley led by a Hungarian, a founder in Sweden, where she lives in Sweden, but she's Hungarian, and most of her team is Hungarian. So, but look, I'm looking to change that. Vizu, which is an amazing data visualization technology and potential platform. I just participated in their first funding round.
And into the Hungarian entity.
Into the Hungarian entity.
Okay, yeah, because
that's
right. Obviously the goal, right? So we don't want to just send all of the startups, to form entities outside because it's easier. We want to build that capacity here.
Well, look, I think there's a question of do you need a Hungarian entity to be a Hungarian startup and to build the team here? I think it's a valid question, really, because look at the entity types and structures available to Hungarian founders in Hungary. You have the KFT and the ZRT. So the KFT is like an American limited liability company. If you're a startup in the US, you are not going to use an LLC, a limited liability company.
Right.
Why? Well, a few reasons. One is there's no proper structure for stock issuance and ownership, which is also a gap with KFTs. It's a makeshift approach that doesn't work, that foreign investors are not going to get comfortable with whatsoever. So if you're a KFT and you need capital for your next round of financing, one, you're probably going to need it from outside of Hungary, and not just Hungary, because there's just not enough capital here. And if you do, no foreign investor is going to want to invest in a KFT structure because of how it's legally set up. It's not a jurisdiction question. It just doesn't work for equity management and other kinds of voting rights and board rights and other things. So then you have the ZRT, which should solve that because it allows issuance of stock and has all these controls in place. Having set up a ZRT here, huge mistake. It's an administrative nightmare, and it also follows this zero-sum principle of stock. Once you have a certain number of stock shares issued, that's what you have. And so if you add a key executive and you want to give them shares of the company, you have to take away shares from other people in order to give those shares to the new person you brought in. It doesn't have to be an executive, could be an employee. It's an administrative nightmare, but all of a sudden everybody else is going, wait a sec, my number of shares just dropped. How many did this person get? That doesn't work. That doesn't make any sense. It's a zero sum. That's not how the system should be. The system should be, we're going to grow the pie for everybody. And so if we need to issue more shares, we issue more shares and give new shares to new investors, to new executives and employees. And so that's a problem I see in this ecosystem as well, which is if you're trying to hire talent as a startup, joining a startup is risky for people.
Right.
So why would they take that risk? A startup probably doesn't have enough cash to offer them a great pay, so you need to make up for it with equity. But the structure to do that in Hungary doesn't work.
Or it's very complicated. The optics are not great.
It's not great. It's not great. And once again, it's not something that a foreign investor wants to put money in. And so I actually think the right approach for any serious founder in Hungary right now, as of today, if you're going to build something that's going to scale, that's going to raise international capital and go international in terms of its market, which any serious startup has to because Hungary's not a big enough market, right. You're better off day one using like Stripe Atlas for $500 to set up a Delaware C Corp in the US and using a KFT in Hungary as a fully owned subsidiary to manage your employee matters and affairs, right? For payroll and other types of things. that can still be a Hungarian startup. You don't need to move. You don't have to go to the US. You don't have to do any of that. But it's a much better structure if you're a serious startup looking to scale a company.
And when you say you don't think there's enough capital here, do you mean at the later stage, or do you mean
so let's talk Series A.
Yeah.
And Series A these days is $5, $10, $15 million raises.
There's not a lot of players doing that.
Look, I really like the VCs that I've met here, but they're probably going to write $1 to maybe $3 million /euro checks, right? They can be great participants. They can be awesome help and support for the founders here. They might even lead a round, but you're still going to need millions from outside of Hungary.
Why do you think there are not so many later stage vehicles here?
Oh, in terms of the funds?
Yeah.
Oh, well, I think there's two reasons. One, you just don't have the history of capital accumulation. And two, there's not enough successful startups coming out of Hungary. I think the problem in the Hungarian startup ecosystem actually starts at the very beginning of enough good companies being founded. There are challenges every step along the way thereafter that need worked on, and I look forward to being, a member of the community here that actually addresses those bit by bit. And I know it can be done, by the way. That's the other thing is I was recently in the Baltics. I was in Estonia and Lithuania, and I was meeting with the founders and VCs and other people who have built up that ecosystem over the last 15 years. They're a great role model for Hungary to follow. Hungary doesn't need to follow Silicon Valley, or London or Berlin or Israel or something as an example. All we have to do is look to Estonia and Lithuania. They are smaller countries with smaller markets who have come out of some of the same history and economic systems, who made very specific, deliberate choices in terms of design of their startup ecosystem to get it going, ramped up. They had a few successes. Those few successes resulted in a whole bunch of people who had great experience building startups, making good money coming out of the exits, who then go found more companies and go become angels and invest in the next generation. And those ecosystems in Lithuania and Estonia are rocking. What do they have? 1 million people for a population? They don't have more talent, engineering and science and tech talent than Hungary. Hungary has every opportunity that these countries have.
So what do you think are what are the elements of the model that we should adopt here?
So one, we talked about this CART type question.
Yeah.
I think there need to be some changes in terms of how equity gets managed and issued that is much more favorable for building proper startups in Hungary. I think both of those countries took a model where the government VC programs co-invested with angels. They would not invest in a startup unless there were angels lined up to co-invest with them on the same deal terms in a way that sets up that startup to be able to be successful in raising future capital as well. I think those are a couple of examples that need to change. The other thing they did in Estonia is they had meetings every 3 to 6 months with members of the government in the key areas, the let's call it, ministries of finance and tax, for example. They had lead VCs, they had lead founders, they had other key parties in the ecosystem, and they would meet and they would discuss the issues that were holding back the ecosystem, and they would break them down bit by bit, month after month, year over year. And now they've got thriving ecosystems.
And you're starting to have some of those conversations here. Is that right?
I am. Absolutely. I think I'm just trying to take these observations of here's what I'm seeing. Here's the challenge with it. Here's why this is an issue. Here's what it means for a founder. Here's what it means for an investor. Here's why the deal won't get done. Here's why they won't be able to get to the next step or be as successful or as likelihood to reach the next phase. And here are alternatives, and I don't like bringing alternatives from Silicon Valley as like, this is how you do it. It seems so foreign and far away, but I think these examples from Lithuania and Estonia are outstanding role models for Hungary to follow.
And so what would you say? I know you're here to shake things up, right? So this is and you're starting to do
That's
this.
What founders do, right?
Yeah.
You're not an entrepreneur unless you're going to try and disrupt an industry a
right,
little bit.
Say some controversial things.
That's right.
So what are in your perspective, I know you said we got to start with the early stage, and
Yes.
I totally agree.
Yeah.
Like fix the early stage and then,
That's
things
right.
will follow.
Mm-hmm.
What have you seen though so far in terms of, just because you've met with a lot of entrepreneurs, probably seen lots of startup ideas.
That's right.
How would you compare kind of the quality of the early stage deal flow right now in Hungary?
Just to be candid, it's light and it's not strong. There are some great founders here with some great early stage businesses. They exist, and I think there could be a whole lot more of them. There are a lot that they don't have the right initial founding team. For example, they have maybe some tech or scientific talent, but they don't have anyone who can play the role of CEO and build it. That's a common issue. They have a solution in search of a problem, and they're not sure how to really think about what is the specific problem they should solve, for whom and how, as a total solution. I would call it an obsession with product market fit that does not exist here as much as it needs to. This singular focus on finding product market fit at the earliest stage. It is not coming naturally to the startups that I'm meeting with here.
How do we cultivate that, in your opinion?
Well, I think a few things. One is let's talk about the tech talent not having a CEO or maybe a business person not being able to find a technical co-founder. A few things that we can do to help solve that. One is starting at the university level, we need to have entrepreneurship courses and competitions that have funding attached to the winners for them to be able to go launch their startups. The most formative experience I had at MIT was not in any of the coursework that I did. It was an extracurricular activity competing in the MIT 100K competition, working to found a company, getting connected with real engineering talent to help me really explore and potentially build a company. That set me up for success when I actually launched real business later. And actually a friend of mine who ended up winning the competition got him launched into his entrepreneurial journey. We need that in Hungary. We need those kinds of opportunities. I think it starts with that. The other one is it's not just for university folks. Hackathons. Hackathons done in such a way where you bring together people with business ideas or tech ideas where they can pitch them and get paired with people who complement their skill set. So if they're an engineer and they've got a new technology, but they need somebody with a business mind, the business mind can find out about it and be paired with them to start working on it. Or vice versa. Often you have people, business ideas, but they have no idea how to pull it off technologically. They need an engineer to start hacking on it. Pair them together, get them working together for 24 hours, 48 hours, build something. You see this actually coming out of the Baltics now. It's been really successful, and a number of startups have come out of it. Belarus even now has joined onto that Baltic program, and several startups have come out of there, moved to the Baltics, and started growing. It's a model that works, and it's a model that works in countries that have similar attributes to Hungary.
You think that's interesting because there's mixed, it's maybe controversial. How do you do this kind of founder matchmaking? Because I think in some cases, there's been some success stories, but I think, it's also pretty challenging when you're just meeting somebody or you just get to know somebody, but you're, bullish on this. So you think it's a good approach? I think
there's just too many examples where it happens and it works. So it's not going to happen at all if you don't find the match.
Right. And so facilitating opportunities, at least for these people to come together.
That's right.
Okay, so we got to get more competitions going and hackathons. What else? What else do you see here?
We need first check funding.
Check funding.
Check funding.
We have you here to fill this gap.
I hope so.
Everybody, you're
I
going to
shouldn't be the only one, and I welcome more to come and help out and participate. This is not something that any one person is going to fill the void for, but hopefully can make a dent.
What about this though? I mean, I feel like just kind of uncovering or discovering and empowering people to be possible angel investors. Or
sure.
I guess what you're saying, we need to kind of fix the fundamentals. So get
fundamentals.
Get there to be, vehicles where you can do this.
Can they use a convertible note?
That's kind of the basic.
Can they use a safe note?
Yeah, but then
those two questions being completely unanswered at this point are crushing the ecosystem right now in terms of the ability for early stage startups to get proper early stage first check funding.
But then in terms of, I guess, educating, or, I mean, you're here also interested. I mean, do you have plans to have any sort of, I don't know, angel boot camps or something like this where you're giving back that knowledge, or are you open to being a mentor for prospective angels as well?
Absolutely. Anybody who wants to participate in this ecosystem and help it flourish and grow, I'm here. I'm a partner. I'm here for the long run. I'm not moving back to the U.S. This is now my home. I want to make my home a better place to be. I benefited so much from being a part of the ecosystem in Silicon Valley. I know I would have failed without it, without other founders and angels to give me advice and guide me and help me along the way, not just financially, but just avoid making mistakes or focusing better on what really mattered. The only reason I had the success I did is because of that. And I know it. Like I was at a breaking point in that journey early on, and so knowing that if I had been Hungarian and tried to build a company from Hungary, that I would have failed, and the difference was that I was in Silicon Valley. How do I help change that? Like how do I help bring what I got out of being a part of that ecosystem to Hungary, so that others can benefit from that as well?
Yeah, absolutely. So who writes first checks in Silicon Valley now?
Oh boy, it's funny. Back in the day when I was raising money, it was Ron Conway. Ron Conway,
that was the
probably
guy.
Hundreds, thousands of investments. Like if you wanted that stamp of approval, you needed Ron Conway, and I couldn't get Ron Conway. I got a meeting with him, got the pitch. He didn't invest, right? That hurts. That's hard. Nowadays, probably Chris Sacca. He's often on Shark Tank in the U.S. and others. Who's behind Uber and a number of other companies. But yeah, I mean, they're super angels. And obviously, I'm not going to do anything quite at their scale, nor should I. But look. We need somebody to fill that void here in Hungary.
Well, maybe Jared Schrieber. That's who you go to for first checks in Hungary.
Really. If you're a founder and you're serious about scaling a real startup internationally, I hope I'm the first call.
You're going to get a bunch of pitch decks after this podcast goes
live.
Great. All right. I think we are about running out of time here. Is there anything else? I think there's been a lot of gems here in this conversation. Lots of advice, lessons learned. We have a lot of founders that listen to this. What's your last bit of advice, or what message do you want to leave them with today?
Focus, focus, focus. And what I mean by that is focus on finding product market fit, narrowing it down to the customers and the problems within them that matter the most, where you can have the greatest differentiation, you can add the most value, and you can excel and then repeat and scale. It may not be the full solution that you have in mind, it may not be the full market opportunity you have in mind, but you won't even get to those if you don't focus singularly on a specific role at a specific type of account, solving a specific problem as excellently as you possibly can so that it's a complete no-brainer. Anybody buying it's getting a 10x ROI, bringing you in. They're a hero inside their company. They're telling others about it. Like, that's how you win. You don't win by trying to boil the ocean day one. Okay.
There you have it, folks. Jared, this was such a pleasure. Thanks so much for being here.
Thanks so much.
We're excited to have you in our ecosystem and can't wait to see what happens next.
So glad to be a part of it. Thank you.
Thanks for listening. Be sure to subscribe so you'll be notified when we release new episodes. Tune in next time as we continue to deep dive and uncover more hidden gems in the Untold Stories podcast. Check out our show notes for more resources about the topics we discuss and anything we mentioned during the podcast. Let us know what was your key takeaway from today's episode. And if you found this content useful, please feel free to share it with anyone else you think would benefit from it.